We have our market marshal of the day. Neelkant Mishra is a chief economist, Axis Bank. He, of course, also looks at strategy. He's the head of global research at Axis Capital. He joins us from the sidelines of the Axis Capital India conference, the curtain raiser. Neelkant, great to have you with us here. It's a pleasure having you with us here on CNBC TV 18. Thank you very much for your time. For a conference like this, interest will be in any way high, and interest right now, I'm assuming, is particularly high. The budget just came and went, which was widely applauded for being fiscally conservative, counter-cyclical, etc. Markets have done phenomenally well. What are the top one or two kind of themes which you think will get talked about the most when you interact with clients, etc., at the conference?
Yeah, so we have 165 companies, more than 500 clients, several very large FIIs who are attending as well. And I think the interest level would be what really will be driving growth in the next 5 years. So will it be investment? So far in the post-COVID recovery, we have seen investments coming much closer to the pre-pandemic path than consumption. Is that a trend that will continue? What are the new drivers of growth? So we have some very exciting panels on new energy, on electric mobility, on fintechs, so there is a lot of curiosity about what is it that will be driving growth over the next 5 years, and we hope to answer some of those questions in the conference.
In fact, it's very interesting, Neelkant, people who are speaking at the keynote speakers at your conference are a lot of the players that are increasing their presence in some of these new age areas, right? Whether it is Tarun Mehta, the CEO of Ather Energy, whether it's Kunal Shah, the founder of Cred. I mean, Cred has recently acquired Kuvera, which is big in the fintech space as well. I want to understand a little more about what the focus area for you will be over the next, say, 12 to 18 months. Where should investors train their gaze at now?
See, for the public markets, I think the earnings momentum and near-term valuations should play a much more important role. And I think that the Indian economy will continue to outperform the global setup. And therefore, the domestic cyclicals, the companies that are more focused on the domestic economy are likely to do well. Now, we are heading into a phase, the next 3-4 months where even though the electoral results are, there's not much doubt left in people's minds, there is still, likely to be some caution. And I think post that you may see, a resurgence in investment. But given that there is monetary tightening, the overnight liquidity conditions are very tight, the fact that the global growth numbers, especially coming out of China and Europe, don't look that good. There is still a risk that perhaps the economy may also slow down a bit. So we are expecting that FY25 would see a bit of a slowdown. But as we proceed and we shape our portfolios for the next 18-24 months, all the areas that we've invited speakers on, things like defense, like electronics, like financials, I think these are going to be areas of interest for us. And these are the ones that we're also recommending to our investors.
All right. Hi, Mr. Mishra. Good morning. Good to see you in. Nigel on this side. Talking about shaping our portfolios for the next 12 to around, 18 months or 18 to 24 months, the banking space is calling for attention. And HDFC Bank, the largest bank out there, that's been a drag actually on the key indices. What kind of feedback, what kind of data points do you all have in mind pitting HDFC Bank, say, with SBI? Because SBI, clearly, there's a lot of interest. I think it's the highest that I've seen in the last few years. Your view, sir?
See, I won't be commenting on specific stocks, but I do think that I think the banking sector as a whole seems to be oversold. The concerns around overnight liquidity. See, what has happened is that the RBI's injection of durable liquidity, the implied money injection that the RBI does, has been nearly zero in the last 18 months. So they have kept liquidity tight, pushing up the overnight rates from the repo rate to the marginal, the MSF rate. What has happened because of excess cash reserves with the government, either state government or central government, is that the overnight rates have actually gone much above that. And what that means for banks is that now their credit growth starts to get capped. their incremental short-term funding is actually coming through at a much higher rate, and they're unsure as to how long this continues, and therefore not really raising lending rates yet. But at some point, I think, given that the credit demand is strong and the banks should have some pricing power, so as some pricing discipline sets in, I think some of the concerns that have plagued the sector should disappear. The significant outperformance that we have seen for the PSU banks, some of it was just a catch-up on valuations. So you see stocks that were trading at 0.3, 0.4, 0.5 times book, now going up to 0.8 and 1 times book. But beyond that, I think the last 2 weeks, there has been a significant change that we have seen because the market's preferring banks that have low LDRs and have greater access to liquidity, or at least expected access to liquidity. But I think these are some of these are short-term concerns, and government cash balances, as they fall, liquidity in the system should improve, and that should help the private sector.
Neelkant, we've discussed this earlier as well, but now with the budget behind us, I think the increase in capital allocation on capital expenditure in sectors like railways, urban housing infrastructure, roads, it's in single digits. And maybe, obviously, over the last couple of years, the government's done the bulk of the heavy lifting in terms of spending. And what they've allocated for FY25 is a sharp moderation in those, how much they'll spend over 24. Now, those numbers may change, but let's just assume for a minute that the numbers are what they are. Are there any implications for these sectors broadly? I mean, it's a space which has done very well on the back of what the government has been spending.
Yeah, so while I think that the government's withdrawal of support is an attempt to calibrate its own presence in the economy, given that the debt to GDP levels are higher than comfort levels. I would not really attribute to the recovery that we have seen in the order books of industrial companies to just government spending. Government spending as a percentage of GDP on capex has picked up a bit, but from 2019 levels. But if you look at levels from, say, 2012 or 2008, when the last two peaks for GFCF, the gross fixed capital formation, had happened, those numbers are not much higher. In fact, what is starting to happen is that after a long time, you are seeing the requirement for industrial capex, and there's also visibility and comfort on the underlying growth, so that companies can invest in their future. So on things like utilities, on materials, on energy, these are the three heaviest contributors to capex. So these are starting to revive. I don't think the government can invest a lot more. So especially if you think about the central government, the two sectors where they can deploy significant amounts of money are road and rail. And on railways, I think the expectation should be that that capex in the next 3-5 years will be much higher than what we saw in the previous 3-5 years. On national highways, I think the phase is now of commissioning, and frankly, much more of acceleration on this base is perhaps not necessary. So I do expect that in the next 3 years, as we think about the industrials in the sector, it will be driven primarily by private sector capex and the pickup in dwelling construction, both residential and commercial.
Okay, all right. We'll leave it at that. Thanks a lot for joining in. Appreciate your time here on CNBC TV 18, Neelkant, and we will, of course, come back to you later. Yeah, have a great conference. We'll come back to you after the conference comes to an end. That is Axis Capital. They have an Axis Capital India conference, which is going to be kicking off. And, of course, the interest over there is immense.